Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you took my advice on Hero MotoCorp, ITC and Jamuna Auto, which I had mentioned in my previous video, and generated good returns in less than a month. That too when the benchmark indices were bleeding. Anyways, let me start with a joke before I talk about today's topic. You know, whenever we go out for a social event and people ask us, market kya lagta hai? Trust me, the majority of us have no idea about the direction of the markets. Well, markets are as confused as they can be, and that makes jobs of analysts like us extremely difficult. And this is precisely why we use the words like volatile, choppy, and uncertainty. Because if we tell you we have no clue where the markets will be, say 2 or 3 days or maybe 1 week later, you will start writing us off. I mean, if Warren Buffett cannot predict with accuracy where the markets will go, how do we know? While I can tell you which stock to buy and at what price, I really can't tell you where the markets will be in a week's time. And trust me, if someone tells you with certainty, please discount him. So that was the current market for you on a lighter note. Now, to start with, a lot of people over the past 2-3 years have been thumping their chest and talking about their portfolio doubling and how they have beaten the market. There is a saying that never let a bull market go to your head and never let a bear market get to your heart. So while nothing lasts forever and even this won't, the signs these days have become pretty much apparent. So before the bear market gets severe, let me tell you 3 things which you should learn from the previous bull and bear cycles. Trust me, the biggest lesson I have learned in my investing career is the pain of not selling stocks. You know, a lot of people buy good stocks and buy them at a good valuation and price. However, they are unable to sell at the right time, especially cyclical stocks and in fact even safe stocks when they cross peak valuation. The art of making money lies in selling at the right time, and when I say the right time, I don't mean at the top. Obviously nobody can. Notional value of your portfolio, apart from the fact that it satisfies your ego, has limited value. Cash in bank is better than the notional price on the screen. So coming back to something actionable, let me tell you 3 signs which make the stocks in your portfolio a screaming sell. The first parameter you should look at in a bull market for selling a stock or a sector is mean valuations and the tendency of the stock to revert to its mean valuation. Let me explain this with a sector example. So what happens when the market prices in more than what it can digest? In a bull market, valuation multiples expand as liquidity chases stocks on the hope of earnings expectations. The trick here is to sell when valuations reach 2 standard deviations above the average 5 or 10-year mean. If you look at the diagnostic space, the way the sector was re-rated post-COVID, as if all of us are going to have a blood test every day during the week. While COVID testing was a windfall gain for a brief period, the valuation multiples re-rated as if this was a long-term revenue stream. Let us look at the diagnostic space from a valuations perspective. I mean, look at the correction from the peak. Metropolis and Dr. Lal have halved from the peak at which it reached just 6 months ago, and the only reason why Thyrocare corrected relatively less is because of the fact of the Farm Easy deal. Forget buying. If you sold the stocks of these diagnostic stocks anytime during the last 1 year, you would have made decent money. Just look at the peak valuations and the mean valuations. Also, the mean valuations for a 5-year period are inflated because of the crazy run-up these stocks have had. Ideally, the mean valuations, in my opinion, should be much lower than these. From a fundamental perspective, these companies were enjoying margins of 30 to 35% and return on capital employed of more than 35%. That is exactly when competition starts coming in, because everyone wants to be in a business where margins and returns on money is so high. That is exactly what happened to the diagnostic space. Tata MG, NetMeds, and many more entered the market. Even a pharma company like Lupin set up diagnostic centers. Well, the result of all this: multiple derating, margin derating, and price crash. Khel khatam. Now the lesson to be learnt is that you cannot buy stocks at these valuations, and you have to keep mean valuations in check. When you focus on mean valuations, you might miss some short-term upside, but you will hardly lose money. Also, one important point is the P re-rating. The P re-rating which happened in the diagnostic space, those multiples you will never get, at least in the medium term. It is a permanent P de-rating which has happened. Now my second tool to see if a stock is expensive and needs to be sold is comparing earnings yield with bond yield. Now earnings yield means the earnings per share divided by the stock price. It means how much has the investor earned per share, while a bond yield is the same with interest divided by the bond price. It also means the earning capacity of the bond you have invested in. So technically, if you want to stay invested in the stocks, the bond yield shouldn't be higher than stocks. Currently, the 10-year government bond yield in India hit 7.5%. Now for stocks to be lucrative, they have to have earnings yield of more than 7.5% going ahead. Also, the inverse of earnings yield is nothing but the price to earning ratio, which determines whether the stock is overvalued or not. The higher the differential between the earnings yield and bond yield means that the stocks are becoming overvalued. Example, a stock with a 5% earning yield means it is available at a 20 times multiple, while a 4% earnings yield means the stock is available at a 25 times earnings multiple. So in simple words, if you see the bond yields have shot up and the difference between the stock's earnings yield and the bonds yield go up, then it is time to sell. Now on a broader basis, Nifty's earnings yield on an FY22 EPS of 806 rupees is 4.9%. Let us assume if Nifty's earnings grow by 10% in FY23 and again by 10% in FY24, the EPS in 2024 of Nifty comes to rupees 975. That still is 6%, which is less than 7.5% of the current bond yield. Isn't that an expensive market? Obviously, this is a general rule, and when evaluating stocks, this needs to be applied on a case-to-case basis. After all, investment is an art and not only mathematics and science. Now the third thing which you should do is to evaluate stocks on the basis of leverage. The thing is, in a scenario of declining interest rates and strong growth, higher debt might give you a positive financial leverage, and that is the reason why in a bull market, when the interest rates are falling, companies with higher debt outperform. However, when the interest rates are rising and are expected to rise further, which is the case now, highly levered companies face a difficult task as business slows down and their interest costs also rise. In fact, some even start reporting losses. At such times, it is pertinent to identify such high debt companies and sell them. So guys, these were the 3 signals you should use to identify stocks or sectors to sell. Remember, valuation is the king, and in a bull market which we have seen over the past 2 years, there were many stories being sold. Ignore them and focus on earnings and valuations. So thank you for watching my video and hope you guys found it insightful.